All right, well, welcome to the Beacon Point virtual discussion. The topic of today's discussion is what in the world is happening with mortgage rates. And with the turnout that we've had for this event, I know that this is a pressing issue that a lot of you are interested in. So thanks for joining us. I'm Kobe Kress. I'm a certified financial planner and wealth advisor here at Beacon Point in Scottsdale. And as a premier financial advisory firm in Arizona and across the country, it's our desire to consistently connect you with high caliber resources that we know will help solve the very real financial issues that you face every day. And it's in that spirit that I'm very excited to have with us today one of the top producing mortgage brokers in Arizona, Zach Wayne. But before I introduce Zach, I have a few housekeeping items for you to make sure that you get the most out of today's event. So on your screens, you should see in the top right-hand side of your screen, you'll see a few icons over here. If you click through to speaker view, we feel like that's probably the best viewing experience for today's event. And then down here at the bottom, and I will remind you of this a few times, but there should be a Q&A button. I want to encourage you, if you have any pressing questions, please put them in the Q&A. Very straightforward, very easy, and we have set aside a chunk of time at the end of the discussion to answer as many of your questions as we can. And then any that we don't get to during the live discussion, we will follow up with you. So don't be shy. If you have questions, don't miss an opportunity to have them answered. Please put them in the Q&A. And like I said, I will remind you of this during the discussion as well. Zach Wayne is a mortgage broker and the founder of Wayne Capital here in Scottsdale. He's licensed in Arizona, California, and Colorado. And since 2006, he has guided more than 1,000 clients through the process of refinancing and purchasing their homes. I can attest firsthand that Zach truly brings an elevated level of experience, professionalism, and knowledge to his craft. And we're excited to have him join us today to discuss all things related to mortgage rates, refinancing, changes to the mortgage industry, especially during this coronavirus pandemic, and much more. So Zach, thanks for being with us today.
It's a pleasure. Thank you for having me, Kobe. It's always great to talk to you and your team at Beacon Point. I think we're pretty dialed in right now. I got a movie on for the kids, and dogs are asleep in the corner. So quietest my house has been in months. Can't promise it'll be that the whole way, but I think we're all set.
Well, I think in this new digital virtual world we're all kind of forced into right now, people will not be surprised if a dog or kid runs on the screen. So not a problem there at all. I think a great place for us to start today, Zach, is to dive right into mortgage rates. So anytime the Fed acts with regards to interest rates, one of the questions I hear most often from folks is, how will that affect mortgage rates, especially those that are maybe looking to refinance or are looking to buy a new home or maybe a second home? So can you take a moment and just explain for us how mortgage rates are determined?
Absolutely. And that is one of the most common questions that we get as well. Anytime there's any Fed movement, what's that do for rates? So first, for anyone who has a home equity line of credit, when you hear, hey, the Fed funds rate, prime rate has dropped or gone up, that immediately impacts you and your home equity line of credit. The next month, you'll see that exact change. But mortgage rates for first mortgages are entirely different. And the way that they're really built, without going down the rabbit hole too far, but essentially when you go out and you buy a home or you get a refinance, and whether it's a $100,000 loan, $500,000 loan, and you go through Quicken, UWM, B of A, etc., the lender takes that loan and it is usually bought by Fannie Mae and Freddie Mac. So B of A, Quicken, etc. still may be your loan servicer and you make your payments to them, but they no longer own your mortgage. They just have the servicing rights. And then Fannie and Freddie actually own your $500,000 mortgage or whatever it is. So what Fannie and Freddie does is they take hundreds, thousands of these mortgages, they pool them together, securitize them, and sell them as a mortgage bond on the secondary market. So it is the demand, the buying and selling for these mortgage bonds that dictate the daily fluctuation in pricing. And there's a lot of end users who buy these mortgage bonds all the way from hedge funds, ETFs, mutual funds, and even your end-line consumer can buy slices of mortgage-backed securities. So that has been the biggest piece of how we follow mortgage rates, and we can see, all right, I watch them daily. My screen's not up now, but all day I'm watching mortgage-backed securities trading, and we can tell rates are getting worse, they're getting better because of the demand and buying and selling of those mortgage bonds. The other part to it, and this has not been nearly as pronounced or as important since I've been doing this for 15 years as the past couple months, but really the simple formula is pricing of mortgage-backed securities plus lender operating cost equals rates. In the past couple months, we have seen just unprecedented wild swings in operating costs that have just had insane fluctuations in pricing. So those two combined together give us what first mortgage rates are. So not so much, when the Fed drops rates, Fed funds rate to 0 to 0.25%, that impacts the bond market and has influence. But more so when the Fed had that emergency action of going in and buying mortgage-backed securities at crazy levels, to the tunes of $40–50 billion a day, that's what really spurs mortgage-backed securities to have massive improvement, and that's where rate swings and things can really start getting better.
Yeah, that's great. So, and I know we've talked about this before in the past. A lot of clients seem to think that maybe the 10-year Treasury is a good metric. Is that a good metric for them to follow to get an idea?
It definitely is. So the 10-year is kind of like the king bond. It's like the biggest player in the bond world, whether it's locally or even across the world. So everyone follows the 10-year. And for your average consumer, and it's up on my charts daily too, so I'm watching the 10-year all day as well. That's probably the easiest metric for a consumer to look at, the 10-year Treasury. If 10-year Treasury's down a little bit, hey, rate should be a little bit better. Treasury goes up a little bit, hey, rate should be a little bit worse. But it's not perfectly dialed in. It's more like those are two of the same players, just the 10-year Treasury is the bigger influencer and mortgage bonds are slightly smaller. But it's like watching, Apple and Google and Microsoft. If one goes up, probably the whole sector is going up, but they're not 100% tied together. And recently, when there's all this crazy Fed action, quantitative easing, and the Fed's buying $billions of Treasury, at 10 a.m. and then at noon they're buying mortgage-backed securities, the 10-year has decoupled a little bit from mortgage pricing. Not a lot, but things are just a bit more skewed now than normal. But generally speaking, 10-year is a great way to follow.
Yeah, great. So to build on that then, and you've kind of painted this picture, maybe you can just walk us through the series of events that have taken place over the last few weeks, as you've kind of discussed here. Obviously, the Fed has taken rates down to record lows once again, and the 10-year Treasury over the last 6 weeks or so has cratered. But yet a few weeks ago, we saw a big spike in mortgage rates. So that has led to the obvious question of what is going on with mortgage rates. So maybe just walk us through specifically to the coronavirus pandemic in the last 6 weeks or so. What has caused that fluctuation?
Yeah, it's been wild, especially compared to Great Recession and how things were then. The past month or two, it's unlike anything I have seen. So in the early stages of coronavirus, before it really hit our shores and we knew how serious a problem it was, mortgage rates for us were a little bit lower than they are today. And there was a period where it was lender capacity was literally being reached. People were refining and buying at such an intense pace. Lenders were just about full. So the first piece to it was mortgage bonds were improving a little bit, but lender volume was too big. And literally they were facing the point of if we lower our rates even more, we'll get so much more demand that all our turn times are going to be shot and we won't be able to service our clients. So that was the first piece to it. Then things start getting a little bit more serious, and the next shoe to drop was margin calls and hedging. This is part of lender operating costs, and usually it's all built-in pricing. No one ever sees it. It's no big deal. But when you go to buy a home or refi and you lock in at 3.5% or whatever it is on a 30-year fixed, the lender locks in your rate, but the price that the lender gets from Fannie and Freddie for that loan is not locked in until it closes. So the way the lenders handle the fluctuation is they literally short mortgage-backed securities and hedge against their own pipeline. So if mortgage-backed securities get better, well, they locked you at this number and it gets better. Well, that's great for them and they made money, okay. But what happens if it's worse? They lock you here, mortgage-backed securities get worse, and now they have to cut a big check on that difference. So they're always hedging against their pipeline to find this equilibrium, okay? And that gets, that's like a whole 3-hour discussion on how that works. But the big thing that happened was when the Fed stepped in and started buying massive amounts of mortgage-backed securities, pricing improved drastically, and that hedging margin call cost just went completely sideways, and lender operating costs and the billions they had to come up with daily to cover their margin calls against their own pipeline was insane. So that was kind of the middle piece, and some lenders got hit really hard and their costs were just extreme, others not so bad. And the most recent piece to it, and this is going to be an ongoing piece, and we're going to discover how this unfolds 3, 6, 12 months out. But with the CARE Act and forbearance offerings for people who've been affected by COVID, job loss, and cannot pay their mortgage, well, if you apply for forbearance and you need to, that's a good thing. No one wants you to go late on your mortgage. No one wants you to foreclose. So if you apply for forbearance and your loan servicer is UWM, but the loan is owned by Fannie or Freddie or another investor, you don't make your payments because you are forbearing. Well, the loan servicer still has to make your principal and interest payments to the investor for you. So over the next 3-6 months, there's a lot of predictions anywhere from plus or minus of $100 billion of immediate losses for loan servicers due to forbearance issues. So operating costs is really the big thing right now, and we're still just understanding how it's going to play out. And there could be another shoe to drop after this that we don't know because, again, this is all unprecedented. So mortgage-backed securities now are at the best levels ever by far, but operating costs have gotten out of hand, and now they're just starting to stabilize. I think everyone's getting a grip on things. But there was a great chart I saw the other day that basically said there's usually about a % difference between mortgage-backed securities and where rates actually are, and right now that is double. There is essentially lender operating costs are double of what they would normally be, and you're talking billions and billions of dollars a day in extra cost. So that's really the biggest thing that we're seeing now as far as the impacts of COVID and pricing.
So you feel like those type of wild fluctuations that we were seeing are a little bit more short term than long term?
I think so. I think the biggest swings initially was when the Fed stepped in and was buying $50 billion a day of mortgage-backed securities, which even during the Great Recession, I think the largest, I'll be off a little bit on the numbers, but the Fed was buying more per day than they were in a full week during the Great Recession of mortgage-backed securities. The numbers were insane. So that alone was huge swings. The margin calls that went directly after that, massive swings. And then since then, we've seen things stabilize. I feel like the crazy volatility is mostly behind us. I don't want to say it's gone, but those wild swings for now are done. And again, I think everyone's trying to figure out what the new norm is for operating costs, and things have stabilized a bit more.
All right, so let's switch gears a little bit. We've talked about interest rates or mortgage rates. Talk to us more broadly about how COVID-19, the coronavirus, has disrupted the mortgage world in general. What do homeowners and home buyers need to be aware of more than just mortgage rates?
Right. So that I think is a really interesting topic, and we won't even have enough time to go into it, but we could touch on a few points. Pricing, obviously, what's my rate, what's my payment, all that matters. But the next part, there's a whole cascading effects of program reductions, loan programs being taken away. And then the second piece is lender overlays. So with the first piece, when this crisis happened, banks being liquid, having money is priority number one. So a lot of the illiquid products were just wiped away. So everyone remembers subprime loan products back in the day, right? Well, those have gone away, and they kind of morphed into something called non-QM loan products now. You know, it's not quite the no-income loans, but there's some non-QM loans out there with some interesting product types. Those wiped away. There's probably still a few lenders out there doing it, but probably 95% of that market died in about a week. Other products that have changed that will impact a lot of people, jumbo loans. The jumbo loan market dried up drastically. There's still a couple big banks are probably still offering some pricing, but Wells Fargo, one of the largest jumbo lenders for the retail side, but also they offer products for correspondents and brokers as well. I don't know the percentages, but a drastic reduction. They cut off the spigot for their jumbo lending. Chase stopped doing home equity line of credits altogether. Chase. So the change in products has been very heavy. Now, your average consumer, $300,000 loan, conventional, FHA, VA, it's all fine. That won't impact them, but jumbo clients absolutely, or some other clients most definitely. And then the second piece, which is the most complex part of it, is overlays. And an overlay is an additional guideline that an individual lender places on rules. So Fannie and Freddie, they make the conventional rules. And let's just stick with conventional for now. So everyone has to follow those minimum rules to be a conventional loan. 620 credit score, debt to income ratio under a certain mark. Lenders, B of A, Quicken, et cetera, can add more stringent guidelines to that. Instead of a 620, we want a 640 to play ball. So those overlays have been some of the more interesting pieces to come in the past few weeks. Some lenders have said, if you have rental properties and you have great tenants and they're paying you on time and everything's great for you, some lenders are not even accepting rental income because they're worried your tenants may lose their job. And if they lose their job in the future, they can't pay you rents, so you can't qualify with that. Now, that's not all lenders, but an example. Business for self clients. Some lenders are saying you're probably going to do less business next year than in years prior. So they're taking a 25% haircut off your qualifying income. Just that's their assumption for being more strict. So the impact on guidelines varies lender to lender to lender. And it's new stuff coming at it every single day. So that makes it difficult for your consumers to understand which way that's going, but that's where your mortgage professional comes in and staying on top of it and knowing what to do. But reduction in programs and changes to guidelines have had a major impact as well.
So to touch on something you said earlier, just to clarify for folks, can you give us the breakdown between a conventional loan and a jumbo? Because some folks may not realize there's a distinction or what that distinction is.
Yeah, sure. So most counties, the conventional loan limit is $510,400. So 510 and change. Most people fall under that. There are some high-cost counties, a lot of California, which we're licensed, California, Arizona, Colorado. Arizona is pretty blanket across the board at 510. California, high cost. A lot of counties go up to 765,000 and change. Colorado's a hodgepodge. There's all sorts of varying numbers by county. So each county is a little bit different. But even when you go to that normal conventional size 510 and you're in a high cost county like Los Angeles County, there's a separate designation for that program as well, and pricing is impacted with that program as well. So every little niche has had impacts by this.
Yeah, thanks for going into that for us. So since we're on the topic of homes and home values, and we've talked about mortgages, what about the other side of that equation? Can you talk a little bit about how home values have been affected by all of this?
Yeah, I think this is one of the more interesting pieces to it. I know everyone is thinking about it, and I reach out to my realtor partners. And again, I'm in Arizona, Colorado, California, so I may not have my finger on the pulse of New York or Texas. But in those markets and the realtors that I speak to, the overwhelming consensus has been that before COVID had its drastic impacts in these marketplaces, it was a seller's market. There was lack of inventory, numerous buyers, bidding wars for homes. Prices were going up steadily. It was a nice pace, but it was a seller's market. So COVID happens, we're all on lockdown and the world changes. So there's a lot less buyers, there's less demand, but at the same time, there's a lot less sellers. A lot of people pull their homes off either for concerns of health and safety, or they're just thinking, hey, maybe this is not the best time to sell my home anymore because I'm just not comfortable, or I want to wait this out. So almost every realtor I've talked to said there was definitely a couple weeks slowdown where just not a lot of traffic, but things have in the past couple weeks picked up pretty drastically. And the consensus seems to be that the demand dropped, but supply dropped as well. So there's still a pretty decent equilibrium to where it's not necessarily a buyer's market, and home values really haven't dropped, if at all. I have heard of a couple of deals, a distressed seller, someone panics, that stuff will happen. But the consensus I'm getting from my realtor partners is things are actually much more stable than maybe myself or other people would have thought. But I do think, as time goes on, 3, 6, 12 months, we'll actually get the data and see what happened. But I don't think we're going to see a drastic reduction right now, at least in home value prices.
So to kind of summarize that, such low supply in, let's say, Arizona, even with a big fall in demand, with people being locked in their homes, not having that supply in place has, at least for the folks that you're talking with, has kept home prices at a pretty, about where they were, pretty stable at this point.
Yeah, that's pretty accurate.
So to build on that, I guess, the big question, and this is what I've heard the most, and quite frankly was kind of the driving factor behind getting you in front of folks today, is if we have people out there that are thinking about refinancing, maybe they were looking beforehand, or maybe Fed cutting rates kind of spurred that curiosity in them to see what they could do with a refinance, or maybe they're looking to buy a home. What's your advice in that situation? Maybe these folks are waiting. A lot of them that I talk to, they're waiting to see if mortgage rates come down even farther from the historic lows that we're already seeing. So what's the advice that you're giving clients?
Yeah, that is a very popular question. And there's a ton of people giving us that question for the past month or two. So one, I think it totally depends on everyone's scenario, right? I'm still surprised at the amount of clients who come in with a 5.5% rate and debt they need to pay off and tons of equity and haven't touched their loan. So there's still clients who are coming in where it's like, this is an instant win today. You're losing money by not doing something. So there's still plenty of people where it's just absolute instant benefit. Some people in the middle, and then you have your people, probably like a lot of clients that you're referring to, where, hey, I have a 30-year fixed at 3.75. Do we try and get a little bit better, or do we wait for these, future rate drops that everyone has talked about? It's a great question, and it will, everyone's individual specific scenario matters. What's your loan to value, credit score, what's your profile like? All those things are important, but generally speaking, when we can provide someone with a refinance at little to no cost and have rate improvement, especially if we can do a no cost refi, I am advising people to take the win now, because we don't know what forbearance and servicing costs are going to do to lenders in the next few months. We don't know the unforeseen items like the margin calls and the forbearance and service. No one was ready for that. No one was ready for it. So we don't know what will happen 3, 6, 12 months. A lot of economists are thinking mortgage-backed securities stay low, 10-year Treasury stays low, and rates could get even better once the operating costs get figured out, but that's an unknown. If you are in this scenario where maybe you can only get better by 0.25%, no, wait and make sure that it makes sense for you and the savings equal the cost. But there is a little bit of risk in just crossing fingers and hoping things keep getting better when we're in uncharted territory. So it's a fine line, and there is no perfect answer. I wouldn't be doing this webinar. I'd be rich on an island somewhere if I knew the perfect answer. But I think in general, it is about looking at the individual scenario, weighing costs versus savings, and then really just dialing it in for that individual client. So on the refi side, that's where I advise most people to go. If you can get the win now, take it. If not, then we'll watch it, which I have a lot of clients doing. The other piece for home buyers is, if you're looking for a primary home, a place to live, and you need to buy a home, you have a safe and secure job, go look for a home when you're ready. I think people who are going to be waiting for a crash in home values may be disappointed with waiting, and they may not see it. If you're an investor and rentals and on that side, that's a whole other deal. But I think a lot of people, as things reopen, may see home values really didn't drop so much. Maybe we should get back in the purchase market. And I think that's what we're seeing already as well.
Yeah, that's great. Thanks for going through that for us. I know that has been probably the primary question that I have received. Is now a good time? And I think it's very similar to it's similar to the conversations we have with folks about investments, in that a lot of this stuff is very unpredictable. You have to look at what your personal needs are and what the situation looks like, gather the information around you, use a professional, get somebody in front of you that can really give you some good guidance in these type of situations. But if you have a great option in front of you that works with your budget, it may be worth at least moving forward and investigating that. So that's great info. We've covered a lot. as we kind of move forward here. First off, I want to remind folks, and we have had some questions come in, so thank you. If you have questions, please use that Q&A button towards the bottom. We do have a chunk of time set aside to answer those questions. And like I said, if we don't get to your question live, we will follow up with you as well. So please put them down in the Q&A. Zach, maybe you can give us kind of a tidier picture of what the future of home lending is going to look like in a post-coronavirus world.
So that's what we're trying to figure out. And so far, I think the past week or two, I've already noticed more lenders being competitive with pricing. Some lenders who they lost a lot of money with margin calls and they priced out of the market just to wait. They're coming back in already pricing wise. So that's encouraging to see. More options, more competition, better for the consumer. The overlays and guideline easing, a lot of people are saying that's really going to be tied to COVID testing, treatment, but also jobs and what happens with our economy. In loan world, everyone's worried about jobs and if people are going to have employment or not, and that's where a lot of these overlays come from. So I think as states reopen, people get back to work and jobs numbers look a little bit better, those restrictions are going to start to ease. As that happens, you know, the big question is when is jumbo lending going to come back? And line of credits are still out there. A couple places stopped doing, but when do those products start coming back? And I don't have a good answer for that. I think that may take more time. I think it's easier for lenders to stick to the basics, conventional FHA, VA, Fannie Mae, Freddie Mac buys the loan, they turn it, they make a profit, and they're on to the next one. But that is a little murky as to when jumbo comes back and comes back in a meaningful way. But I think there are signs now, more lenders being active, being competitive. They want to see jobs, though. They probably want to see better jobs numbers and better economic forecasts for things to really loosen up. But that being said, I mean, you can still close a purchase in 15 to 20 days with the right lender. Rates are still low. They may not be as low as they would normally be if we didn't have this, but at the same time, they're right at the historically low levels. So there's a lot of opportunities for people. Just depends on the scenario, but I am hopeful that there'll be more easing and opening up of some lender overlays and program guidelines in the coming months.
Yeah, great. Thanks for kind of wrapping that up for us. And I have one more question, and then we'll pivot and do some audience questions because we have had some good questions come in. So I want to make sure we have plenty of time to address those. But I know there's a lot of people on this call who maybe have a rental property or are interested in the idea of rental properties. And I think a lot of that stems from opportunities that people saw back in 2008, 2009, and maybe another event like this has kind of spurred that up back in them. So can you talk a little bit about rental properties and the landscape for rental mortgages right now?
So that's becoming a more common question, and it's there's not a good answer for it yet, but I'll tell you what's going on and we'll kind of give a forecast as to what may happen. Some lenders literally cut the rate sheet in half and weren't offering higher rates, which you need on a rental property. They just kind of washed their hands of it for the immediate future and said, we're not even offering financing on rental properties. Some lenders have those overlays I mentioned where you can't even qualify with a rental income. So if you make enough money, you can still qualify, but that hinders a lot of people too. And some lenders, no major overlays, and you can still do some financing. But that being said, the pricing for rental properties is not great today. Comparative to when rates were higher, yes, there are still financing available and you can still buy a rental home. But the common question is, hey, I bought a rental home 2 years ago and my rate is X, 4.5, 5, or whatever. Can I refi and get a lower rate? The answer today, no, without paying a ton in fees, which does not make sense for most people. So the question is, when do the rate sheets start to normalize? When there's bigger margins from each rate as you go up, and which will equal better pricing for rental loans. I really don't know that answer. My personal guess is in the coming months, again, with easing restrictions that we're starting to see, that hopefully lenders open up that part of the rate sheet a little bit more, but there's a lot of back end to it as well on certain mortgage bond coupons and the demand for those higher rates, and that's a whole side conversation. So my personal opinion, if I had to guess, I think in coming months, I don't think weeks, I think coming months, rate sheets will start to look a little bit better for rental financing. If you have some astronomically high rate or you're looking to purchase a home because it's a great deal, still opportunities for you. But if you have a good rate already on your rental and you're looking to refi, it may take a couple months for something to be really attractive.
Yeah, great. Well, thanks for going through all that with us and giving us a pretty clear picture of what's going on in the mortgage world. We have about 25 minutes left set aside for some audience questions. So let me remind you again, there is that Q&A button at the bottom. Please use it. If we don't get to your question, we will follow up with you with an answer. So please don't be shy. Use the question and answer there down at the bottom. So let me pull up here, Zach, and we will dive into some of the questions that we have that have come in. So the first question I have here is, what is the interest-only mortgage option situation looking like currently? I'm building a home and planning on using the proceeds of the sale of another home, but the coronavirus has seemed to slow home sales a bit. We are considering either an IO or an ARM if it takes longer than we anticipate to sell the home and then refinance to a 30-year. So the gist of it, what does that interest-only or maybe adjustable rate mortgage landscape look like?
Got it. So that IO product is pretty bleak at the moment. Some lenders out there still offer them, not many, and the ones that do, it's probably going to be a very high interest rate. Can't speak for every lender in America, but the vast majority of those programs were stopped about a month or two ago. IO usually falls under either non-QM and or jumbo programs, and both of those got hit really, really hard. So IO offerings drastically reduced. You'd have to do your homework, and if I could guide someone to point them to the right avenue to find one, I'd be more than happy to, but they will be much tougher to come across in the immediate future. Those may take a little bit of time to come back as jumbo loans come back and non-QM comes back, but they're not part of the standard conventional loan product matrix, and they're just not going to be your everyday offering. So because of that, a lot of lenders have gotten rid of them, and it's just going to be tougher to find for the immediate future.
Yeah, great. Let me pull another question here, and I think we touched on this one a little bit, but I'm gonna give it to you, Zach, just so you can make sure we put a good bow on it for this attendee. But the question here is, if I sell an investment property and have to do a 1031 exchange, what's going on with non-owner occupied rates, and what do you see happening with those rates over the next 6 months?
Okay. 6 months probably correlates to the time frame you have in the 1031 exchange, right, to roll it over. So right now, you know, I can pull up an exact pricing scenario if someone has an exact question later and go over that. There are options now. So if you have to roll that over because of tax savings and you have a good opportunity to buy a home, there's people still buying rental homes. I have a couple clients that are still out there doing it. It's just the pricing landscape is different than it was 2 months ago. Expect to put 25% down. You don't have to, but it's a lot better pricing with 25% down than it is with 20. So that's one piece just to kind of be aware of and know. You know, whether pricing will be there for you in 2 months or 3 months or 4 months, super tough to say. And I wouldn't base your purchase off of it. I would, because again, there's still opportunities there. There's still financing there. I would focus on finding the right deal for yourself, the right property. Go there first. And if you have to take a higher rate now, and maybe there is a great rental refi boom 6 to 12 months from now, then you can take advantage and lower your rate at that time. So I wouldn't be deathly afraid of it. I would just say plan on 25% down if possible, and just know that rental pricing, you know, it's a little bit off of what it might be normally.
Great. Let me pull another question here. And thank you all for the questions. Have some great questions coming in. So thank you for sending those over for Zach. Got a question here. Is there currently such a thing as a 10-year or 12-year fixed rate loan, or has it all gone to 15, 20, or 30-year loans?
So you can get conventional loans from a fixed, from 8-year all the way to 30 in the conventional world. The pricing, though, is going to be, you know, what people are driven to. And there is a 10-year product bucket where like 8 to 10-year loans are priced. And then there's a 15-year bucket where 11 to 15-year terms are priced. And you can do a 27-year, 23-year, and so forth. But the pricing on 15 and 10 and those products in that mix are really not that much better than a 20 or 30. There used to be, again, when rate sheets were normal, there was a nice spread. Your 30-year, your 20-year, then your 15 was way down here, and you would see a 0.5% larger improvement. That huge jump is not there right now. Again, rate sheets need to normalize and come back to normal. So people, often ask that question, and also, well, your 9-year fixed is this rate and your 15-year fixed is also the same exact rate, and there's really no difference today. You let me know which one you want, and if you want to be forced into, paying on the 9-year term, let's do it. But the pricing incentive isn't really there right now. Hopefully, again, that changes in the future, and the 15-year gets, we can see that bigger price reduction from 20 and 30.
So there are more products out there. People can tailor it to what they're looking for. You just have to look at the pricing, make sure it makes sense for your situation.
Correct. Yep.
Yeah, great. So I have a couple questions here that are around the same theme. So and it really kind of boils down to, when refinancing, how much of a decrease in interest rates is typically needed for a refinance to make sense? And I do get this question a lot. Rates will come down. I'm sure you do too. Rates come down, and then all of a sudden people want to know, does it make sense for me to refinance? How much does it need to come down?
So there's a lot of schools of thought on that, and I have my own, naturally. There's some people that say you have to have a full % reduction to 3/4 of this. I think that's entirely the wrong way to look at it, because there's two pieces to it. It's rate reduction, which that branches off into how much does that save you. Do you have an $80,000 loan and it saves you $20 a month, or a $500,000 loan and it saves you a lot? So rate reduction, but cost. So if anyone's thinking, I have to save a full % to have it make sense, well, maybe how much does that loan cost you? What are the closing costs? If you could save a 0.5% for zero cost, which we do a lot of no closing cost loans, depends on the scenario and all that stuff. But if you get improvement for free, get an appraisal waiver sometimes, all closing costs are paid for, it's an instant win. To me, that's an instant win for people. It's a no-brainer. But maybe there's $2,000 in closing costs, $5,000. It really depends. So at that point, yeah, you start to look at what's my monthly savings versus the cost. What's my break-even point? Are you going backwards to a 30-year from maybe you've been in your loan for 5 years? We have to take that into account. So I truly think, and not to sound like a broken record, but every scenario is different. I don't think there's one standard rule. Someone may have PMI and we can remove the PMI, or you're going from this loan program to that. So I think the big picture that's not talked about in my industry enough, everyone's rate. What does that loan cost you? What does it cost you to get that rate? And that is the second piece to the puzzle that varies per scenario. I'm a fan of no or low closing cost scenarios, purchase or refi, if possible. I've been in the business for 15 years, and it's not always going to be this way, but when you look in the long time span, it's a falling rate environment. For 15 years, it's been a falling rate environment. So almost anyone who said, I'm going to pay high closing costs to do that buy down has lost, because now rates are down here and they want to refi and they wasted all that money. So low closing cost, no cost is always a great option. Rates won't go down forever, but at the same time, I don't think it benefits people to pay a ton in cost. So that's that equilibrium we try and find when we're making that analysis.
Well, I think this leads well into, I have a question here that's a little bit more specific. So we can use it a little bit maybe as a kind of a case study and give some more specific guidance here. But the question here is, if you were buying this summer, and let's use Arizona in this case. So we're buying in Arizona this summer, and you were going to put at least 20% down, so 20% or more down, and you plan to keep the home that you're buying for at least 10 years. How would you refinance the rest? Where's the deal out there for folks that they should be looking, in your opinion?
Could you rephrase the question? I'm not sure I understand the second part.
No, that's great. So buying a home, gonna put in Arizona, gonna put at least 20% down, maybe more, and they plan on keeping the home for 10 years. So they kind of have it set in their mind, after 10 years, they're going to get out of this home and maybe move to something else. How would you finance that other, let's say they put 20% down, how would you finance the other 80%?
Got it. So let's assume we're in the conventional loan world and we're not into jumbo and more complex things, conventional loan. First thing is, it always comes down to monthly payment. If you can afford a 20 or 15 and get a slightly better rate, fantastic. If not, or you just want the flexibility of a 30, usually sticking with that is always a good way to look at it. Going back to someone's going to keep the home for 10 years, that doesn't mean they're not going to refi in those 10 years. So a lot of people say, I'm fine with, again, we're going back to cost, because it's a big part of what we do and how we compare things. Well, I'm going to keep the home for 10 years and I'm not going anywhere, so I'm fine buying down my rate or doing it this way or that way. You may keep the home for 10 years, but you may want to refinance for a multitude of reasons. There's all sorts of unforeseen circumstances. Rates get better, well, that's an easy one. Maybe you want to shorten your loan term because or you cash out or cash in, all sorts of things. So I would still focus on a low risk, low cost, 30-year fixed basic product. If they can afford a 20 or 15, absolutely look at that. There's no guarantees on what the next 6 to 12 months are going to look like, but it's possible that there'll be even lower rates coming out if these operating costs for lenders get figured out. And a lot of people may come back to refi once again. So I would stick with the same formula, low risk on the lending side. Don't pay a ton of cost. It's not worth it in my opinion, because the vast majority of people will refi far sooner than they think.
Great. We have a couple more questions in here that I think are timely and good for folks, and then we'll see about wrapping up. And as I said, if we don't answer your question directly, we will follow up with an email. So please still put your questions in there. But I have a question here that I think we've heard a lot about this. We've heard about interest rates, but we've also heard about closing times. So how has the coronavirus and this environment affected closing times for loans?
Yeah, that's been a wild swing as well, and it's a very good question because it's been all over the place. Purchase refis are two different animals with most lenders. They'll fast track purchases, and refis kind of push to the side a little bit. Now there's a couple lenders who just stopped doing mandatory 60-day rate locks. So things are improving now across the industry. Several weeks ago, there was a few major lenders who were requiring 90-day rate locks on refis. They were saying it's going to take us this long to get to it. And purchases, most places were still doing a 30, some may be taking a little bit longer. So I think purchase market, I think most people will be safe with a 30-day close, maybe 45 if you need to, depending on, there is a difference when you're working with a big bank to some other lenders that may be more streamlined. Refis, again, same difference. Each bank that you talk to is going to be a little bit different, but those turn times are starting to come down and be a little bit more reasonable. So maybe in that 30 to 45-day window. We still have a couple lenders where if it's a purchase that needs to go in 15 or 20 days, it can happen. But that's not going to be every lender out there. So they got hammered big time, but they are improving on turn times.
And you've brought up another question in my mind as you were going through that. One of the things that I was hearing a lot was that there were new stipulations being put on borrowers coming into their close for income and things like that. Has any of that changed? Are they requiring letters and things like this that we're hearing about?
So that's been an interesting maze, and it's. Each lender, again, has their own rules on how they do this. But when everyone started to realize what was going to happen with job losses, a lot of lenders were doing same-day verification of employment again, like a re-verification again, second, third time, but day of funding. So everything's signed, closed, but you can't fund until your employer verifies your work. Well, your employer might be working from home, and maybe calls aren't forwarded to them, and it caused a little bit of a fiasco, and a lot of people scrambled. So the re-verification thing varies from lender to lender, but I think it's here to stay until jobs improve. We're still seeing big job losses. Once that stops, I think that process will calm down a little bit. But that was an interesting maze to navigate because everything happened so quickly. There wasn't a ton of guidance for us, and it was just, and here's what you have to do to fund the loan, and you have 2 hours, and everyone's working from home. The call centers are closed. You can't just call HR because HR is not there. So that was a very interesting ordeal for a few weeks. But again, everyone's starting to figure things out and figuring out the new procedures for that. So into the future, I still expect it, but hopefully it's a little bit more orderly. A big piece of that will still be, who's back at work and who's still working from home. And I know we've talked about this, what is the new reality for working from home versus going back in for the next year or so in the future? I feel like a lot of industry-wide, everyone needs to kind of sort out their logistics, and whether you're at a call center or a 5-person mom and pop shop, I think there's still a lot of figuring out that people have to do in all industries as to the logistics of working from home and how that really operates.
And can you add on that quickly for us, retirees? So other added stipulations for retirees that are trying to get a mortgage that are no longer working. They don't have earned income from a job somewhere. How has that affected retirees?
Most retirees have had the least impact for qualifying purposes. The only real impact that I could see, and if something else pops in, I'll let you know, but a lot of retired clients maybe only have Social Security income or a pension, and they use IRA distributions or 401k distributions to qualify for mortgage, for retirement age. A couple lenders said, you know what, the Dow was at 30,000 and now it's what, 24, or was it 20? So if you had $1 million in your account or $500,000 in your account on this last statement, well, it's a lot lower today. So a few of them were a bit more stringent. Hey, what's your updated balance? Or we're going to make you take a 25% haircut off of your balance and off of your distributions. But overall, retirees have had, from a qualifying standpoint, the easiest go in loan world. Not too many extra stipulations for them.
Great. So I have one last question here, and then we will we'll wrap up. Again, if we didn't get to your questions, we will follow up with you. And I think this is a good one kind of to send us out on here. The question here is that you mentioned operating costs, and what are kind of the indicators that folks should be looking at, or what are you looking at to see when those operating costs are going to come down or improve, and therefore kind of filter through to mortgage rates?
That's going to be tough for me and tough for the consumer to figure out. The biggest thing that we know of right now is the forbearance issue. You can kind of go online and Google the amount of forbearance that's out there. So it's really going to be tied to forbearance and jobs. That's going to be the easiest metric that even you, me, and your average consumer can look at. Besides being in the pricing war rooms of these lenders and really seeing what their forecasts are, and how many individual loans that they service are in forbearance. Maybe one lender has a portfolio that's doing really great, another one's getting hammered. We don't know that. So there's a lot of internal with that, but nationally, job losses, and you can look up the forbearance numbers and just Google them and see how they're going like this right now. They're still going up. That's going to be the easiest indicator. Bottom line, jobs, jobs, jobs. If you have a job, if I have a job, we should be able to pay our mortgage, and then the forbearance issue will go away. Costs should come back in line. There could be future things that we don't know about because, again, we're all in uncharted territory, but that's the biggest metric, is jobs.
Great. Well, Zach, thanks for taking the time to be with us today. I think this was great. We had a lot of really great questions come in. I know this is a timely topic. Let me close by saying this. Here at Beacon Point, we understand that these are uncertain and uncomfortable times for folks out there. It's during these times that our clients rely on us more than ever, which is why we will continue to provide you with regular, up-to-date, and what we hope is really useful information for you. So to that point, you're going to receive an email. We'd love your feedback and your questions. If you're currently not a client of Beacon Points, but you feel you would benefit from a discussion with one of our advisors, please simply let us know by responding to that email. That email will also include a link to Wayne Capital's website. So if you do have more mortgage-specific questions, or maybe you're looking for a refinance, or you need to have that conversation, you can contact Zach directly using that link. From all of us here at Beacon Point, I want to thank you for joining us today. Please stay healthy and stay safe out there, and we look forward to seeing you again at a future event.
Thank you very much, Kobe. Thank you, everyone.